Welcome to The Explainer, where we take complex topics and turn them into clear visual stories. Today, we're going to cut through all the noise and try to build a real, usable roadmap for investing in 2026.
I mean, that's a huge question, right? There is a flood of information out there, and honestly, it's pretty easy to feel lost. So in this explainer, what we're going to do is build a clear framework, starting with the big picture and then drilling down into some ideas you can actually use.
Okay, so to invest smartly, you can't just throw darts at a board of stocks. You really have to understand the whole economic landscape. And in the US, let's be clear, the single most important force shaping that landscape is the Federal Reserve.
Just think of the Fed's interest rate decisions like this. They're setting the climate for all of your investments. When rates are high, borrowing gets expensive, and the economy kind of cools off. But when rates are low, things tend to heat up. This idea, it's the fundamental backdrop for literally everything that follows.
So, what's our starting point? Well, after a whole series of cuts designed to cool down inflation, the Fed ended 2025 with its key interest rate sitting right here, in this range. You can think of this number as the baseline for pretty much every financial decision coming up in the year ahead.
So here's the crucial point. The trend is expected to continue downward. The forecast from iShares suggests the Fed is going to keep cutting rates in 2026. Now, this is a huge signal for investors, because as the rates on super safe things like cash start to fall, the hunt for better returns somewhere else really starts to heat up.
But how can we kind of peek into the future? Well, one of the most watched tools from the Fed is this thing called the dot plot. Just imagine a chart where every single Fed governor anonymously places a dot where they think interest rates should be in the coming years. Now, it's not a promise, but it's an incredibly powerful map of their collective thinking, and it's really the clearest signal we have about where policy might be headed.
All right, so we have the economic forecast in mind. Now, what can you actually do about it? Let's shift gears from the what to the how and start building a tactical toolkit for your own portfolio.
With interest rates expected to fall, the whole game plan for bonds really changes. The core idea is to shift away from just letting cash sit there. So first, you could put that cash to work in short-term bonds. Then, you might think about locking in today's higher yields for longer, before they disappear. And finally, for anyone willing to take on a bit more risk, you can seek higher income from things like high-yield corporate bonds.
But hey, a portfolio isn't just about bonds, right? Let's pivot to the growth engine, stocks. A really popular way to invest tactically here is through exchange-traded funds or ETFs. You can think of these as baskets of stocks that you can buy with a single click to target very specific goals.
And as you can see, these three ETFs represent three very different tactical bets. VPU, that's a defensive play. You're betting on stable, maybe kind of boring utility companies. VOO is the classic bet on the biggest players in the US economy. And with SCHD, your tactic is to focus purely on established companies that consistently pay out cash to their shareholders. Each one is like a different tool for a different job.
Now, what's really fascinating here is the nuance you find even within index investing. VOO is incredibly popular, for good reason, but VTI offers even broader diversification. By including over 3,000 small and mid-sized companies, VTI captures the entire US stock market, not just the big guys at the top.
Okay. All these tickers, strategies, economic forecasts, it can feel like a lot. It can be overwhelming. And it raises a really important question. Do you actually need all this complexity to succeed? This leads us to a powerful, and I mean radically simple alternative philosophy.
This whole idea was popularized by the Bogleheads. They're followers of the Vanguard founder John Bogle, and it's built on a single premise: simple beats complex. You can think of it as an anchor of simplicity in a sea of overwhelming financial noise.
And here it is. This is the core concept. Instead of trying to pick sectors or time the market, you just own everything. One fund for all the US stocks, one for all the international stocks, and one for all the US bonds. That's it. The whole thing.
And here's what that looks like visually. It's just three core building blocks. The only real decision left for you is the mix, how much you put into each slice of the pie. And that decision? It depends entirely on your personal comfort level with risk.
And the why behind this whole approach, it's incredibly powerful. This isn't just about being lazy or easy. It's a deeply strategic choice. By minimizing your costs, minimizing human error, and maximizing diversification, you are basically betting on the long-term growth of global capitalism itself, rather than on your own ability to outsmart it. The argument here is actually pretty profound. Over decades, this simple, disciplined approach has a very high probability of outperforming the vast majority of those complex, active strategies that are always trying to time the market.
So, we have covered a lot of ground. We've gone from the Fed's big economic forecast all the way down to two fundamentally different ways of building a portfolio for 2026. And this brings us to the final and maybe the most important question.
It really all boils down to this choice. What's your mindset? Are you a tactical investor, analyzing all the data to position your portfolio for what you think is coming next? Or are you more of a simple boglehead who believes the best path is to just own the entire market, keep your cost to a bare minimum, and simply stay the course?
Ultimately, there's no single right answer here. Not for you, not for anyone. The best strategy is always the one you can actually stick with. But understanding these two opposing philosophies, the active tactician versus the simple owner, that is the first, most essential step. The real goal isn't to perfectly predict 20